All right, ladies and gentlemen, I just got home from Disney Springs and Disney did report earnings. Now, this is a stock we've been following for a significant amount of time for a company that was trading around 115 to 110. We all know the recent sell-off, and the flack that I got on saying Disney could break below $80 was ridiculous. And what ended up happening? Disney did hit a 52-week low of $78.73. As you guys can see here, this analysis is about 2 to 3 years old. Had a $70 to $75 price target roughly, but said it would be okay to start reaching anywhere the stock hits in the 70s just because the amount of levers that this company can pull. And the multiple is the biggest question. This might be the hardest stock to actually put a price target on. When we talk about stocks trading over $100 billion market cap, the market usually has a pretty good idea for what the stock should be trading for, whether that's your mega tech companies or any company really that's $100 billion or more. And Disney's probably one of the harder companies to really put a price tag on because the intellectual property is really a hard number to figure out what it's truly worth for the consumer. But where I find this company interesting is, once again, how many levers they can pull. That cutting costs is going to be a significant part of what Disney's doing. They could be reinstating a dividend. So a tremendous amount of good news going in the stock. And we can see here that the stock is up roughly 3% on the day. But when we factor in where we had the price target around $78, $79, this is close to a 10% move here, a little over a 10% move. So let's dive into the numbers. So revenues for the quarter and year grew 5 and 7%. Diluted EPS from continuing operations for the quarter increased to 14 cents from 9 cents. And some of the highlights are Disney Plus added 7 million core subscribers for the fourth quarter, but projected to lose some subscribers for Q1 of next year. So when I'm looking over the quarterly reports, I really think the few things that are really pointing out to me is the fact that subscriber growth is now reaccelerating. That was a big concern to investors. ESPN is showing some positive signs with year-over-year growth in all international sites. So when we think about reopening, this is the tailwind we were talking about Disney. And so when we were thinking about what kind of levers could Disney pull to really get me personally excited about the stock, when we look at the 4 key building opportunities that will be central to our success, achieving significant and sustainable profitability in our streaming business, building ESPN into the preeminent digital sports platform with now sports betting being available, I believe, by next week. And so when we bring it down to a free cash flow basis, they were doing a little over $1 billion, now doing $4.8 billion in the year ended. And in this quarter specifically, doing $3.4 billion of free cash flow. And there's more cuts coming here, and they're going to get more efficient on streaming. And they're going to be adding some significant things to ESPN, which is all making Disney a little bit more interesting here. And when we factor in that a lot of bad things were being priced for Disney, this was the type of turnaround that we wanted to see Bob Iger take. So everything is looking pretty good here. We're going to just breeze over everything else really quick. So entertainment is up roughly 3% on the year. Sports are down 1%. And experiences are up 16% year over year. So seeing their 2 largest segments heading in the right direction is really going to offset everything else. And this is what makes the streaming aspect of their business really powerful, because streaming is not efficient right now, but they have the content library, they have ESPN, they have things in place here where they could be a powerhouse in streaming, and I want to see them get aggressive. I've mentioned the fact that a company like Paramount, trading at $8 billion market cap, could be acquired probably for $12, $13 billion. And now all of a sudden, Disney could add a company like Paramount and Paramount Pictures to their platform with CBS. Makes a tremendous amount of sense with the complementary of ESPN. And then getting CBS along with ESPN could be very, very powerful on a platform. We all know that linear is fading out here and direct-to-consumer is the concern. As we see here, direct-to-consumer is in double-digit growth and linear is coming down at nearly double-digit growth. So as long as that direct-to-consumer is outpacing linear, should not be impacted by their overall revenue and overall earnings. They ended the year at $88.8 billion of revenue, which has outpaced what my projections were of $84.5 billion. So we did a pretty good job projecting out where revenue was going to lie with Disney. Now with these extra levers being pulled and maybe free cash flow becomes a little bit more efficient here, we're going to leave everything at where it currently is right now. Projecting out top line revenue for 2024 is going to come in around $94 to $95 billion, which is still giving us that price target of 2030 being right around 150 to 175 per share. So you could do the forward math on that if you buy a stock at $80 versus $75. But I'm sticking to my thesis here that $75 to $78 was a good buy. We did get some shares around $78, $79. This is definitely becoming an interesting stock to own. I think they're doing the right things. I think they have the right management in place. And I think they have a tremendous amount of levers to be pulled here. Of course, it's all going to come down to valuation on this stock. And that is the hardest thing to figure out with how much intellectual property this company has versus how much is coming through their free cash flow, how much can they personally grow. How much can they really grow on the streaming aspect? How much more can they charge for the parks? How much more can they charge for streaming? A lot of big question marks, but if they can get costs under control, that is really the variable I'm personally looking for to grow that free cash flow. Overall, I would say Disney's earnings are pretty solid here. I think free cash flow growing is nice. I think the ESPN aspect is very nice. I think the cost-cutting story is very, very interesting here. And so overall, I would give it about a C+. I think so much was priced into the bad side of Disney that all this positive news with management now getting things under control, free cash flow coming through, still strong growth in certain aspects of their business shows that there is still a tremendous amount of opportunity. And if they somehow can maintain those subscribers going into the first quarter, they are guiding down for subscriber losses. But if they can maintain subscriber growth in the first quarter of Q1, I think this is going to be a very strong year for Disney, as long as the consumer remains strong. And what we're seeing is the consumer is willing to spend regardless here. They're racking up credit cards. So, while I do think we're going to head into a recession at some point in 2024, I do think Disney is actually heading on the right direction. And if you do get opportunities to buy this in the 70s or even possibly 60s, I do think with the IP, with the intellectual property and how many levers this company can pull, the fact that they are a pretty significant topic when it comes down to the streaming aspect, I think an acquisition of Paramount makes a tremendous amount of sense for this company. But we will see what happens here. How aggressive are they going to get? With that free cash flow now growing, they could make more mergers and acquisitions. So we'll see what takes place. But I think overall this is a C+ earnings, and I think that the 3% pop makes a lot of sense. And there could be some follow through here where we start seeing it approach $90 a share. Of course, this is just my opinion, but we will see you in the next one.